You're about to see breaking market footage that will shock you. Oracle, once hailed as the next trillion-dollar AI powerhouse, is suddenly collapsing, wiping out over a third of its value in just weeks. And what you're about to hear raises a much bigger question. Is this the first crack in the AI boom? Stay with me, because this is more than a sell-off. This might be the moment Wall Street finally admits the AI debt rush has gone too far.
What should we be taking from this pullback, Oracle's in particular? We've been talking about it for a while, but I guess the bigger question is this decline a cautionary tale for the rest of the space?
I believe it is. If Dan were here, Dan's been talking about it for a while. I think collectively we've been talking about, it's a cash flow problem at a certain point, and you have to wonder. Now, Michael Burry's been writing about it as well, and I went back and looked at all the Twitters and the videos back in September 10th, September 11th, and people were tripping over themselves to say how bullish it was for Oracle and how this would be the next $1.5 trillion, $2 trillion company. And we sort of looked at each other and said, you know what? There's a lot to be gleaned from this in terms of what's the earnings going to be on the back of the revenue that they're talking about. Now you're talking about a cash flow problem. We've retraced the entire thing, as you said. This is the September low, and it remains to be seen if the stock can bounce from here. This is a logical place for it to bounce, but the bloom is off the rose here, Mills.
All right, let's break this down. What we just heard is not simply a bad quarter or a temporary dip. Oracle is showing the exact symptoms of an AI bubble that's growing too fast, too expensive, and too debt-heavy. The company added $38 billion in new debt since September, and that's before next year's massive data center build-out even begins. But here's the real story. Oracle isn't alone. Meta, Amazon, Alphabet, even Palantir all got hit today. And the market is finally asking, if AI spending is exploding, where are the profits? We're entering a new phase where AI ambition meets financial reality. Higher debt, higher interest costs, lower margins, and suddenly those trillion-dollar dreams look a lot shakier.
Their debt by $38 billion since September alone. Mm-hmm. I mean, that is a massive build, and it's still coming. I mean, The whole space, they've already pledged that they're going to increase spending next year. That is going to be funded by debt primarily.
Yeah, so they don't have the cash flow problem at the moment. Mm-hmm. That's not where they are. But, when they talked about that enormous backlog build, the margins on that backlog were much smaller. Mm-hmm. And now we have... they're likely to have higher interest expense, right, for two reasons. One, just the magnitude of how much debt they want to sell, and others as well, so that market could get saturated. And then some concerns about, okay, well, what is the promise of this data center return? And so do we debt holders need more interest?
Right.
So you can see how you get into this sort of negative spiral there. I don't know how much of it to make is just a little bit of like a frenzy right now. My gut is that it's more structural than that. It is a bigger problem. Even while we're talking about this just today, right, we saw huge deals. It's almost like a race to just get your headline number out there. I don't know if that's to get a position in line for debt. I'm not quite sure what that is. But when you look at Meta's response, the stock's response to that build, that's, as a shareholder, very, very frustrating. I think if they were, if we were to see the year of efficiency next year, I know that's not Mark Zuckerberg's plan at all.
Right.
But that would be very nice for the stock.
2.0 would be probably pretty good. What does that chart look like, Oracle, the decline?
I mean, we can talk about the chart for a second, but I think the real thing is, if one were sitting there and they were just graduating with their PhD in finance and they had to present themselves in front of the committee, and the committee said, well, you've made an analysis on Oracle. And they said, yes. Did you use a dividend discount model? Did you use enterprise value EBITDA? Did you price the sales? Some of the parts. How does anyone explain, myself included, how a stock can go from 250 to 350 back to 250 in a matter of weeks? Is anything changed? The debt's not new. The story's not new. Just because it's in the news, there might be some issue with margins. They're overstating this. But this speaks to the vagaries of markets. These are risk assets, right? Now the question is, but here, and to your question, do you buy this 35% sell-off? My hunch is that just as it was in favor, now it's so almost out of favor that I think you can play it for a bounce.
Oh, so bad it's good in this case.
Well, it's an extreme move. You've retraced the whole thing. And again, that's a trading judgment. I can't speak to it, and I would never want to, because clearly no one else can, what this thing's worth, right? No one has a clue.
This is TheCryptagon. Stay sharp, stay informed.